Tēnā koutou katoa. Good afternoon, everybody. My name is Stuart Dickinson. I'm the New Zealand Country Lead for DXC Technology. It gives me great privilege to welcome the panellists here this afternoon to hear hopefully what will be an engaging debate and conversation around these key topics. For over the last 30 years in New Zealand, DXC has built, managed and supported critical government infrastructure. And certainly as we think about our communities and sustainable outcomes today, the importance of that infrastructure, how we deliver that in an evergreen and continuously improved manner becomes critically important for the future. We're excited to take part in the transformation journeys for all of our customers, whether or not they're commercial or government agencies across New Zealand. And so it gives me incredible privilege today to welcome our panellists. The first panellist is Matt Whineray, who's the CEO of the New Zealand Superfund. Matt was appointed CEO of Guardians in July 2018. Matt's achievements include overseeing the development of the fund's climate change strategy, risk allocation process and risk budget framework, along with strengthening Guardians New Zealand and international direct investment capabilities. Matt is a member of the Focus Capital on Long-Term and a Director of Netball New Zealand. He's previously served as a member of the World Economic Forum General Agenda Council on the Future of Investing and as Chair of the InZone Education Foundation. I think he will be a great panellist. Secondly, I introduce Craig Hudson as Managing Director of Xero for New Zealand and Pacific Islands. Craig is a member of the senior Xero executive team at Xero and responsible for driving relationships with government, financial institutions, enterprise and promoting small business economy. He's been with the organisation for over 7 years. In 2017, returned to New Zealand from the United Kingdom, where he led Xero's entrance into Europe, Middle East and South African markets. He's also a successful former rugby player who has spent more than 8 years playing professionally in New Zealand, France, England and Wales. Finally, I'd like to introduce Karen Silk, who's the Experience Hub Manager for Westpac New Zealand. Karen is responsible for supporting and chairing Westpac New Zealand's Climate Change Action Working Group. Sustainability is a key focus in the work that Karen does. She helps drive Westpac's commitment to lending over $2 billion towards climate change solutions by 2020 and overseeing the issuance of New Zealand's first green bond in June 2019. A board member of the New Zealand Sustainable Business Council since 2017, she was appointed chair in 2019. She is also co-chair of the Sustainable Finance Forum, a work stream of the Aotearoa Circle. So we have a wonderfully diverse and accomplished panel today. We certainly look forward to the conversation. I thank you for the opportunity to spend time with you today. And now I'd like to invite the panel to come up and we'll get the conversation underway. Thank you.
I'm an unsuccessful former rugby player.
Well, Matt said he was here to entertain, so I'm waiting for the question of dance.
I know, they've talked it up a lot, haven't they?
Love to humour aside. Kia ora, thank you Stuart, and to my fellow panellists. As most of you can see, I'm a stand-in, and I'd like to particularly acknowledge Karen for becoming a panellist and letting me moderate. You're much better placed than that. So as Stuart said, the Climate Change Commission released its report in June 2021. A roadmap showing the government how New Zealand can cut greenhouse gas emissions and meet its international obligations. Depending on the extent that the government implements the proposals, nearly everyone is going to be affected, and that's why we felt that it was so important to have this conversation with all of you today. Our panel have been formally introduced, but I just wanted to reiterate why we thought it was really important to have this cross-section of the New Zealand business community. So Matt, obviously CEO of the Superfund and co-chairing the Sustainable Finance Forum, working on the roadmap for action last year. Craig, as you know, is the Managing Director of Xero New Zealand and Pacific Islands, and his input today is critical as a representative of small business and high-growth tech companies. Karen brings a wealth of insight and perspective today from her experience at Westpac and role alongside Matt on the Sustainable Finance Forum and as you heard, also chairing the Sustainable Business Council. So I'd love for today to be interactive. I've of course got some prepared questions, but we want to hear from all of you. We do have a roving mic as well, which my colleague Dora will bring to you. So feel free to catch my eye at any time, put your hand up and we'll bring the mic to you. To start though, I'd like to ask each of our panellists, looking at your own businesses and your own journey to net zero, how did you get, or are you getting there, and what were the major milestones? Matt, would you like to start?
Sure, thanks Sharron. So we've got, well, I guess our business is the Guardians. That's a pretty small entity. The big prize really is thinking about the fund. So the fund these days is roughly 59 billion, and how we think about the climate change risk that's inherent in the holdings that we have in the fund is critical to our climate change investment strategy. So we started that journey quite a long time ago. We joined the Carbon Disclosure Project back in the 2007, 2008, and have been thinking about this for quite a while. 2016, we announced our climate change investment strategy, which was focused on how do we reduce the risk inherent in the portfolio that in the form of climate change risk, both transition and physical. And that looked to reduce the exposure to climate risk exposed assets. It looked also to analyse how we think about the incorporation of climate risk in the pricing of assets. We engage with companies, we vote on climate change resolutions, and finally we search for opportunities to invest in the transition, because the transition is going to be significant both in terms of the conversion of the energy system, but also around adaptation, which is probably where, frankly, a lot more money is going to be needed than we think at the moment. So we've been implementing that strategy for about 5 years now. We're not at zero. We're effectively zero from a reserves perspective, but for us to get to zero in that portfolio relies on companies to ultimately get to zero. And so that's where we're focused around things like disclosure. TCFD is obviously pretty important, engagement and voting, and ultimately how those companies are getting there, because we can't, as an investor, get ourselves to zero without the companies managing their emissions profiles.
Thank you, Matt.
Yeah, kia ora koutou katoa. It's been a bit of a journey, and Rod would say that he's been on this journey from almost day one. From very early on, Rod would ask the team to be able to pull the number of invoices that have flowed through the system, and he'd do some magical calculation and tell us how many trees we've saved. So from those days to where we are now, some of the key milestones that were put in place were enabling our team to have a voice, and to the point where it was almost internal activism within the business of driving us to do better and demanding that we do better. We had members of the team that were actively weighing rubbish, recycling, going through, putting different signs on in different locations in the office and seeing where best placed to get the best results for reducing waste from within different business units across Xero. And we enabled, as executives sitting back relatively passive, we enabled them to effectively become champions of the response to start with, which drove quite a lot of change and buy-in from the ground up. The next milestone was realising that this was a real thing and we needed to invest in it. Now we've established a dedicated SEI team, so Social Environmental Investment team, with international expertise that has guided us to the point where at the end of 2019 we became net zero at Xero, where we're offsetting predominantly to start off with all of our air travel, and invested in 3 projects, one in India, one in Borneo, which is around the orangutans, and then one New Zealand-based project, because this is home for us, in Freeman's Bay, just out of Akaroa, which is a reforestation project. And we are now certified net zero carbon neutral company as a whole, not just air travel, but everything. Gone through quite a process of reducing emissions within the building, so lighting, for instance, eco lifts, which can be quite frustrating because they take a little bit longer, and how we operate as a whole, taking into account the commute that members have to come in as well. So it's quite a broad look that we have. We are now 100% sponsoring the Freeman's Bay initiative, and I was fortunate enough to be able to go down there. And there is no stark contrast between the traditional and the new. When you talk to the farmer that's been on that site for many years, and he is torn. Him and his wife have been there for years. Their kids don't want to take over the farm. The most profitable part of that farm is not the half that is still in livestock. He holds on to that because it's who he is, he's a farmer. The other half is carbon, and it is a third more profitable than the traditional farm. But he is torn because of the values that he has. So we are heading that way really quickly. As a company, it gives our people pride. It aligns to values, it aligns to bigger purpose, which means we're able to attract better talent.
Nice, congratulations. Karen.
And thanks. So we think about this in two ways. First one, much like Craig, what are we doing as a company? Because it's important, if you want to talk about this topic, then you need to be role modelling the right behaviours in terms of that. And we actually started on our environmental journey here in New Zealand in 2008 when we began measuring our carbon emissions, our carbon footprint as an organisation. In 2013 we moved to net zero through the purchase of carbon credits via the ETS system, and then in 2019 we became the first bank in New Zealand to become carbon zero certified, which means we're actively reducing our operational emissions in line with Paris Agreement's 1.5 degree ambition, and we moved to offsetting the remainder by purchasing native permanent forestry carbon credits rather than looking at purchases by the ETS. As a service company, our emissions aren't high. They are derived from our business operations, so travel, being that air travel, non-EV vehicle emissions, and electricity usage. And so we've been actively looking at ways that we can reduce that. Very popular piece of work was the removal of cars and car parks, where we felt they were no longer required. We'll always endear you to your staff. At the forefront of that, no, it didn't make me very popular at all. Migration, we made the decision to migrate the residual to plug-in hybrids or e-vehicles. We've just over 30% there at the moment. We've got a target to be 100% within, I think it's the next 12 months. Kate will tell me if I'm wrong. And so we're actively looking at ways that we can reduce that. Our next step though is, as Matt's talking about, is how do you start to deal with your scope 3 emissions? So through your supply chain, and then importantly for us, with the role we have in the economy, is through our lending practices. Data is fundamentally important in order to be able to, first of all, assess where those emissions exist, and so working closely with business customers in particular to understand that's incredibly important. The second area for us though is also understanding the exposure we have to adaptation risk. So one thing we do know is that we can't, it doesn't matter what we do from here, there are some risks we will not avoid as a consequence of past activity when it comes to climate. And so working in collaboration with NIWA in particular over the last 12 months, we've spent, 18 months, we've spent time understanding the risk that sits within our portfolio from rising sea levels, so coastal erosion, inundation, and last year we released our first climate disclosure report utilising the TCFD framework, but importantly bringing through clarity around what exposure we carried in our mortgage portfolio as a consequence of rising sea levels. The one thing we learned through that is that the level of accessibility and transparency of good quality science-based data in New Zealand isn't where it needs to be. We're an incredibly immature nation when it comes to that, and with the requirement to move to TCFD reporting in 2023, that is a significant issue that we all need to face into, and there's a role for collaboration between business and government in getting that right.
Thank you, Karen. So, following on from that, Matt, perhaps you can share more with us about what do you need, or what does the New Zealand Superfund need as investors? So what business processes need to change, talking about TCFD, learning, data points, etc., to get to a comparable number, a useful comparable number, and whether you can help versus where companies should be producing it themselves.
Sure. So Karen and I have spent the last couple of years leading up to the end of last year working on the Sustainable Finance Forum roadmap, and what that was coming up with a set of practical recommendations for shifting the financial system to one which properly incorporates both the impact on business of these long-run societal and environmental trends, as well as the impact of business on these long-run societal and environmental trends. And so that's quite a shift from a financial system perspective, but it's one that we're looking at in terms of best practice, responsible investment practice around the world these days, that move to that sustainable finance construct. What do we need as investors? We need data. That's the point that Karen just made. The TCFDs, I think, will be great as a way of pushing that along. I think we've got increasing uptake of those voluntarily at the moment from companies both here and across the Tasman. Probably a little bit more, interestingly enough, across the Tasman than here at the moment, if you look at the large indices, or the indices of the large players. But ultimately what you need is some data that's comparable across industries and through time in terms of the climate risk. I know that there are a bunch of CFOs in the audience today, and when we talk to people, we feel the rising panic from CFOs, who generally are the ones who are tasked with producing this because it's a report, so you have to produce a report. But actually, what's interesting, we did our like Westpac, we did our first TCFD report last year. The reporting is far less important than what it does in terms of the conversations that you end up having in your business, because everyone gets very excited about the risk and targets, and we hear, oh, well, how do we do scenario analysis? That's really hard. And we're like, well, hang on, wind back a little bit. If you look at the TCFD, there's there's four big headings in the TCFD. It's governance, strategy, risk management, and metrics and targets. The metrics and targets are last, because actually what you need to do is say, who owns this risk in the business? What are you doing to incorporate this risk in your long-term strategy? How do you incorporate it in your risk management? Who owns that? And then you get to metrics and targets, which is where you start thinking about, how do we measure our footprint, and what should we be aiming for, and how do we do scenario analysis, which is always the place where the numbers people, CFOs, end up straight away. But actually, this is about how do you change your business practices to incorporate the questions of these, this big question.
So I want to bring SMEs into this conversation now, Craig. How do we bring everyone on a journey, and are we running the risk of creating another divide?
Well, we are. Just the jargon that's been used already, I have no idea what you're talking about. So I feel very divided. So we need to be acutely aware that 98% of entities are 20 and under employees in this country. 29% of GDP comes from that part, and about 28% of all employment sits there. So for us to be able to get out of our bubble of big business in the lens of how is this going to impact me, we need to be able to elevate up and how is this going to help New Zealand. And small businesses don't have HR departments, they do not have SEI teams, they do not have the ability to get consultants with expertise to be able to tell them what acronyms mean, let alone how to action anything. So we need to democratise as much of the learning that has already happened in the likes of Westpac and Superfund, and put it in the hands of everyday New Zealanders so that they can action something tangible every day for small business. Otherwise they will get left behind. And the debate quality will be like it has been in the last couple of weeks, where we're just fighting over units, which is pointless. It doesn't move the needle forward of what tangibly we can do every single day in small business New Zealand. And they will turn off. yet they're a massive chunk of the economy that we have to support in any way we can.
Thank you. So one of those things, Karen, obviously finance. So can we talk more about sustainable finance? And your view of how we can shift capital from traditional business models to new business models to remain resilient and mitigate the impacts of climate change?
Yeah, so Matt's already talked a bit briefly about, we spent a couple of years looking at just that topic, and what it would take to shift. In effect, we both went into it on the basis we don't want to create an alternate asset class. What we want to do is understand what it would take to shift mainstream, be that funds management or banking sector, to adopt a different mindset and move away from thinking about this from the impact that you have on one aspect being an economic outcome, so whether that's a GDP measure or a pure profitability measure, to one where we understood and working to short-term time horizons, to one where we understood what it meant to think about the impact from a broader stakeholder perspective. Because if you actually want to create long-term shareholder value, you need to understand what the holistic set of risks and potential opportunities are for your business. So when we look at it from a banking perspective, we spend a lot of time talking to our customers around what they perceive their risk to be, and then we sit down and we prepare a 12-month forecast, and if you're doing it properly, you will then stress test it and come up with your own scenarios, and it never goes beyond 3 years because really you only believe the next 12 months in terms of what your customers told you. So for us to step back and think about that, it means a reframing of the engagement that you're having with them. And so the kind of questions that we're starting to ask are leaning much more into thinking about points around governance, understanding what disruption might mean for your business. How are you as an organisation taking a view on what the potential risks and opportunities are that look like on a 10-year horizon, and what's supporting that, what is supporting that. And so that's where the point around TCFD becomes really important. And this is a bit of a journey that we're all going on at the moment, but what we're starting to see is collaboration occur in a good way. SAFI is a piece of work that is evolved out of the Sustainable Finance Forum, and that is Sustainable Agriculture Finance Initiative, and that is a piece of work where we have all of the banks involved working with MPI and other market participants to actually understand what the implications are for sustainable agriculture in the future. It's then obviously up to each organisation to come back and think about how you might start to embed that into the financial decisions that you make. But there is no doubt that this will happen, and all of the participants understand that unless we start to think about those longer term risks, we're not actually going to do the right thing by our customers because they're not thinking about the long term risks and consequences. We're not doing the right thing by our shareholders either, because we will create unknown and unplanned risk in terms of the portfolio of assets that we're managing. And so as part of that journey, what you're going to see is banks are going to start embedding this into their credit decisioning frameworks and start thinking about that. Today we have what we call ESG credit policies, and we bring it through in terms of an additional assessment. What we're starting to do is now say, well, actually, how do we actually embed that in a more fundamental and even more traditional benchmarking framework to understand the risk that sits within those business. And that will mean ultimately one day we get to the point where we start to allocate capital differently against that risk, and we can start to price that risk fundamentally differently as well.
So we welcome your questions. Does anyone have a question to start with? David.
Hi, David Bell.
Sorry. Yeah.
Hi, David Bell from Xero. Quick question around the sort of the language and the perception. I feel at the moment the whole challenge is one of cost. How do we change it round to a challenge of excitement and opportunity that everybody can get into? And not to pick on you, Karen, but just because you last spoke, how can we change language from the concept of risk to the concept of profit? How do we change the language to this is the better way to farm, etc. So I just feel we'll get a lot more engagement around the business community.
You're absolutely right, and that is the discussion we're having internally. Don't just think about this from a risk assessment within the portfolio or within that particular exposure, but actually how do we take that same information, start to share the implications with the customers and start to provide the tools to enable them to either transition their existing business into something which is creating more sustainable proposition, and or actually how do we start to identify and support businesses that are looking to grow because they're offering a different proposition. I'm looking at Matt Ward here from Solar City, and Matt, apologies, but I'll just talk a little bit about that. Solar City is a business that rethought what its proposition was in market and migrated from an entity that was a provider of solar panels to an entity that was providing renewable electricity service. And that's quite a different way of thinking about how you might lend to an organisation like that. But the structures that you use are exactly the same structures that we've used for what I would call more traditional services. It's just rethinking what the outcomes are and how you measure success in that kind of environment. That opportunity exists, and that is exactly the way we should be thinking about these things.
Thank you. Another question for the panel?
Sharron, can I ask a follow-up on that? Because I'd be really interested to hear Craig's response.
Nice.
I don't get to do this very often. So I'm going to make a really long statement without a question in it. I'm really interested to hear Craig's response to that question, because in politics we talk about the fact that there's basically only two kind of ways of politics, hope or fear. And I'm always want to be on the side of hope. And I just think that's a really important question when you're raising what you said before, Craig, about the democratisation. What's the hope version of that for small businesses? Because I think some of the larger entities are so far further down the path that the switch will happen, but I'd be interested in your view on SMEs on that.
Yes, thank you for that long question. So I got a little bit of data that came through actually this morning on the SG funds that over the last 12 months, the previous 12 months, there was about $51 billion went into the SG funds. And in the first quarter of this year, it was about $21 billion went in there. So the money is flowing that way, and it has to start at the top, in my view, and we need to be telling stories that this is where your focus and energy will flow. And how do you then bring that down to make it actionable for small business? And that's where the just transition is really important, to be able to articulate to a business owner a small business owner who intimately knows the families of their staff and their members of teams, and how they can actually help those families progress, be more prosperous by training them into the new world, and how to give them new skills that they don't currently have today. And it's not only about the individual and taking the family on that journey, but you're taking almost the entire community on that journey too. And it makes it more real when you talk about those impacts. And I think from a small business owner perspective, that heart on the sleeve, they are solely responsible for food on the tables of their families. How do they do that when it's not just another cost or a tax on a tax or another few sick days? How am I going to handle that? Or minimum wage increases, but actually the true prosperity and opportunity for their teams. And I think the story that I'm getting back is that they're just waiting, they're wanting to be able to do more for their staff, but they can't, because they can't charge enough for the service, they can't attract the right customers. But if you're telling the right story as a small business owner, you can attract the right story. And we've seen that through COVID, where small business was in a heck of a hole, yet New Zealand community stood up and supported them like we'd never seen it before, but we've almost gone back to 2019 again. So how do we tell more stories of these ethical small businesses that are already doing it too?
Yeah, one of the things programs we run here is a program called Growth Grants. and it's targeted for small businesses. They come in and they tell their story, and we have a panel of judges, and we look at their business, and then ultimately end up picking a winner, and they get a bunch of rewards and financial assistance and various things. But a few years ago we made the decision that we would apply 20% of the score had to be, what is your story around sustainability? And it fundamentally changed entrants that were coming through, and but more importantly, it actually, the feedback I got from a number of companies over the years is it changed the way they thought about their business, because it forced them to start sitting down and thinking about what their business practices were and realising the value of those business practices and starting to embed the good sustainable business practices in the story that they told. And as a consequence of doing that, a number of them said it was the sole single determinant about whether we won or lost business following on from that, because people were coming to them because of the they could tell a really strong sustainable business story. So the role of storytelling becomes incredibly important, particularly when it comes to the smaller business category as well, because every business has the ability to do something. It's just being able to understand what it is that is within your control, and then being able to actually take action on that.
Yeah, I think the demographic of the people that are looking for this type of information is changing a lot now too. With the rise of Sharesies and Hatch, and we're getting away from this exclusive investor opportunity to actually everybody. Like my son invests on Sharesies and he's 14. And he's looking up what businesses stand for, and your ability to be able to harness that or miss out on an opportunity is really real. And to your point, coming back to that, the social responsibility of the storytelling that comes along.
Nice. Another question for our panel?
Great panel. Wendy McGuinness speaking, McGuinness Institute. This is sort of a question about our constitution in terms of our response to the pandemic and how well I think we responded by having the Epidemic Committee and the Ministerial Cabinet Committee. So I'm interested, we need a non-partisan, durable public policy response, and the Minister referred to that. How do you think that we could calibrate a system around climate change? Because obviously it is an equally, if not more important emergency that we're dealing with. So I just wonder if the panel and the Minister would like to respond. So non-partisan, how do we do
Oh,
that?
sounds like a no-look sunny bill.
Dora, do you mind just taking over? Thank you.
Now I don't even have to pretend it's a question. Yeah, Wendy, I think that's really the attempt of the Zero Carbon Act process in the Independent Climate Commission. In a sense, that is the non-partisan body, as it were, in that we sent off, similar thing with COVID, it was the experts, they went off, they consulted widely and wildly, and it gave us a blueprint, which was then workshopped again, and then comes forward. So, in a sense, that is, to me, that's the document, that's the thing. The institutional arrangement that then might sit under that, that's challenging for politicians. We had the original Zero Carbon Act passed 120 votes to 1. Guess who the one was at the time. I hope that kind of broad consensus still exists, but when you get down to the individual policy making areas, there's invariably a little bit of tension. But we think that the emissions reduction plans that have been issued by the Independent Climate Commission are a non-partisan blueprint. And then how you then implement them and the pace at which you do it and the way that you give a just transition is the sort of semi-political bit. Interestingly for us, we have a similar funding and financing challenge to work through. And that's where, again, I'd like that to come up above either the annual budget cycle or the 3-year political cycle, because the commitments we need to make from a government funding and financing point of view are 10, 20, 30, 50-year commitments. And I said at the budget speech that I'm working on that now as to how to look, to include the disciplines and the good things of the Public Finance Act, but give us the ability to look over a much longer horizon around funding and financing. That will require a bit of cross-party work to get through.
I think I'd also add it requires a bit of cross-departmental work to get through as well. It's one of the things that we said, that we suggested in that roadmap was a whole of government sustainable finance strategy, because where you need the big economic ministries, which is obviously Treasury and MB in particular, who are over either the procurement or the distribution of significant amount of capital over the next 30, 50 years, thinking about how we incorporate, for example, the living standards approach, and how do you, I hate to use the word operationalise, it seems, but how do you operationalise, thank you Ron for that, how do you operationalise that living standards framework, because it's a great concept, but we haven't got to the point yet where people are making decisions on the basis of it and saying we are now thinking about these headlines from a wellbeing perspective, and this is how these different projects impact it. And climate is so fundamental to that, that it does need not just not just partisan, but non-partisan and bipartisan, multi-partisan, but the government agencies really working closely together as well.
Matt, we've talked a little bit before the panel about what does improving your ESG profile do to returns, and you mentioned Australia, I think, in your opening comments. So perhaps can you talk a little bit about what does it mean from an investor perspective, and what you're seeing, any global trends you're seeing that might be useful to reflect on?
So certainly from our perspective, we have an investment belief that ESG factors are fundamental to long-term risk and return, including climate change. We've done quite a bit of work on this in the course of the last 12 months, as we've had a number of discussions with our board around shifting our responsible investment framework or updating it to make it fit for purpose for going forward. And there's a reasonable amount of data on this out there. The answer is incorporating these things is, I think, fundamental from an efficient market perspective anyway. I don't quite understand for those proponents of that, why you would ignore a set of data and say, well, that's not important. But going beyond that, the research that we've looked at says you almost invariably never harm returns, and most likely or probably improve them depending on which data set that you look at. So we think ultimately over the type of horizon that we care about, those things are important, become important financial factors, and they drive outcomes. They drive outcomes not just from a risk perspective, to Craig's point, but from an opportunity or return perspective. One of the things that our board has tasked us with, in fact we're having a conversation at Investment Committee this week, is that climate change search piece. So how do we've spent quite a lot of time in the last few years on reducing our exposure to this risk, and we proxy that with carbon emissions intensity and carbon reserves. How do we reduce some of our exposure to that? That doesn't change the outcome, that just sells it to somebody who cares less about it than we do. But the search bit changes the outcome, because that's us allocating capital towards investment opportunities that are involved in either that transition, or mitigation in particular, or adaptation. And so that's where we've been tasked with spending quite a bit more of our time thinking about how do we lift our game in that space.
Craig, wellbeing. How does wellbeing fit with sustainability policy? I know it's a shifted conversation, but it's interesting and useful.
I think it's intimately intertwined. If you look at the Māori view of Aora, to the Whare Tapu Wha, to effectively the four walls of the house, and everything needs to be in balance. We get a lot of our well-being from the environment in which we sit, whether that's within your organisation every day for 8 hours each time, or 12, depending on who you work for, or the actual environment outside of the building in real life. That has a monumental impact on the well-being of individuals and communities. So everything has to be in balance, and that's where I think the debate needs to be very clearly balanced to the risk and return, the amount of load that we're willing to put for the speed of transition compared to the ultimate return that, to the Minister's point, we don't know what that return in the future is going to be, but like Matt said, it not only makes good business sense, it is the right thing to do, and it will help our people too, so it should be a no-brainer.
Any questions? Lots, okay. Karen, we've talked about the lending, so your biggest impact is around the businesses you lend to or don't lend to. What does that mean for your customers?
Well, I guess as I talked a little bit before, we're looking at it from the perspective of how do we, first of all, asking the right questions of our customers to understand whether they're considering issues that they need to face into and address. Those that are, how do we help them transition? Because transition's going to require quite a bit of capital for a number of the businesses, and so how do we support them through that process? To Craig's point earlier, how do we support the emerging businesses? And like Matt, we've also set ourselves a task which continues to grow year on year, and which is, how do we direct capital, and we are very transparent around setting thresholds, minimum thresholds for ourselves and targets to direct capital towards environmentally friendly businesses. So what are we doing around that? And that is, and I'd just like to make a comment, it's not easy to get that. We spent a lot of time talking in the Sustainable Finance Forum around what are the frameworks, policies, behaviours and mindsets that need to happen from a supply side. The issue is supply meets demand, and demand today has largely been driven by out of green buildings, a little bit on energy efficiency, renewable energy opportunities, and very little else that has flowed through from that. What we need to see and what we know is that that demand will need to extend further, and we will need to think about energy more holistically. So what are we doing around heat processing, what's happening in the transport area, both at, with heavy freight, like commercial, and then at a personal level, capital support around that. And then lastly for us is adaptation, and I've talked a bit about this. If we think that there's a lot of capital required for transition, there's going to be an enormous amount of capital that will be required to build greater resilience in our infrastructure to face into the consequences that we know will come over the coming decades. And so looking at how we engage in that discussion early and help support that as well.
Thanks, Sharron. Greg Lowe from Becca. I'm involved in the services business, and export services is a very important part of what we do. I had the pleasant experience of spending a bit of time with Helen Clark a couple of weeks ago, and I was reminded of her push towards a knowledge economy and New Zealand's role in leading knowledge export services. And I just would be interested in the views from the panel and whether you think that climate change presents an opportunity for us to take any leading position in terms of solutions that we might develop in New Zealand as a small economy, and how we might leverage that into an export opportunity to help other countries solve the challenges that they're facing. Yeah, I'd answer that by a slightly different lens that we've got on that at the moment in some of our portfolio companies. And one of the effects of COVID and the restrictions on borders has been a willingness for companies internationally to hire Kiwis in situ in New Zealand to work for them. So you don't have to go to Mountain View to work for Google anymore, or Seattle to work for Microsoft. You can do it here, and then that has an impact on the local businesses, because suddenly people start getting paid US dollars and at salaries that Google wants to pay. So so we've seen that as it's a bit of a challenge. But and the flip side of that is that we now there's an opportunity for whether it's individuals or for companies to be able to provide those services internationally without having to be on site. But that's something that we've seen the sort of the other end of it, which is a challenge from a resourcing perspective, which was already reasonably acute anyway. I don't know if you've seen that, Craig.
I suppose if I just look at one of the largest sectors in New Zealand, the agri space, we have a real opportunity to be able to lead the transformation of that entire sector globally. And there's a few players that are born out of New Zealand. If you just one being Halter, that's getting a heck of a lot of press at the moment, that is changing the way that for stock management. But there should be others, and where ultimately Superfund focus was money potentially to be able to invest and support some of these fledgling businesses that are trying to solve these big problems. Could be a great opportunity to be able to get some bright Kiwi minds. There's no shortage of cash around to be able to accelerate that. And there is no eternity of distance, I believe, is no more. We should be leading into this with the lens of going global from day one, tackling particularly the agri space.
And certainly in the research, when we were going through the research phase and engaging with similar entities to the Sustainable Finance Forum here globally, when we were engaging with them around from an industry perspective and what the learnings were that were coming out offshore, the one thing that kept coming back to us is when it got to agriculture, everybody said globally, that's hard, and we're looking to New Zealand to solve that. And Craig's right. We are starting to see some fledgling businesses get created, but there's also an ability for us to collaborate with parties offshore to solve some of the issues that we have here, and then transfer that knowledge offshore again, but more in a partnership approach. But it will take, and there's the start of some of that starting to happen in the agriculture sector, but it's also going to take some broader thinking and acceptance and willingness for New Zealand to perhaps think about some areas that we've treated as taboo, like genetics, and perhaps think about some of that stuff a little bit differently moving forward as well, if we want to participate in that global story.
Is there any final questions for our panel? Sharron.
I've just got a question relating to early stage or high potential organisations, and the current cycle we've got, and I'm involved in a couple where equity seems to be pretty easy to get. Debt is a nightmare, and it sort of feels like the banks are the fund police, so you tend towards equity, which is a bit more.
It's called having regulators looking at
But the sad thing about relying on equity funding for an early stage firm is a lot of the investors aren't very patient, so seek a transaction, and suddenly this fabulous business is off in the world and no longer contributing as much to the productive economy in New Zealand. I mean, are we valuing upside risk correctly in New Zealand? I mean, it just strikes me, being in it, that there's something a bit out of whack here, where equity funding is driving behaviour that may not otherwise occur, and I don't know which one of you, I don't know, Matt, is that something that you're observing?
Well, actually, before I came over here, I saw an announcement from Ice House who's raising an additional fund, which is really, I think, a follow-on fund, perhaps to deal with some of that issue, because I think, you see that, perhaps that desire for a quick turn of some of these things, when in fact, holding it a bit longer would realise, significantly greater outcomes. I'm not sure that, or I don't have it. My experience in terms of the debt funding for these early stage is kind of the opposite. What I regard debt funding as an equity investor, I look at debt funding as just handing someone a gun that they get to point at me in a year's time. and fund some new equity. So debt funding is not, from an equity perspective, is not a great place to be. I'm not sure I agree with your premise that...
We never ever raised that in the forum.
I've never accused Westpac of doing that, but obviously other ones are in that boat. But the equity investor is the residual, is the owner of the residual cash flows, and they're also the one who are going to be the last source. And so when the debt investor says, oh, you know what, we've got a term in this loan agreement, it says this is it, maturity, well, what are you going to do? You know, that often forces some of that behaviour, I think. So I'd sort of prefer, I think where that goes is you need to change the horizon a little bit for some of those. Certainly, you know, what the Minister was talking about in terms of the additional capital that's gone in, both through the Elevate Fund, which we got given to manage, as well as the additional money that's gone to the Green Investment Fund. The idea of that is to try and lengthen some of those horizons a little bit, but it really becomes, I guess to Craig's point, there's a lot of cash around. It's about choosing the right investor in a sense.
Can I reframe that a little bit politely?
Ask your own question, Craig.
I think we have a massive opportunity to actually challenge our tall poppy syndrome and actually sit back and celebrate the success of individuals that have risked everything and have been through, in some cases, sheer hell to be able to, because cash wasn't that easy to get just a few years ago. It is now, but it hasn't been. Yet we've had a few exits this year, in particular in New Zealand, where those founders have actually cashed in and got private equity from offshore. Those employees are still based here. The businesses are still here. They just report to someone else in another country. Yet there is millions, hundreds of millions of dollars getting reinvested back into Aotearoa because of the success of that exit, which drives the next opportunity that the banks won't fund. It gives the we need. There's an opportunity. There is good things. But I really want to challenge our thought process that an exit is bad. And personally, getting the grief that Xero got when we moved to the ASX, that was not on. We're still New Zealand headquartered. We've got close to 2,000 employees based here. We're a thriving business in New Zealand. Yet, for some, that seems non-patriotic. But let's celebrate the successes. It's bloody hard to grow a business in Aotearoa. So let's celebrate it.
I love it. Let's finish on a positive note. We started a bit earlier, so I want to leave a bit of time for networking as well. But on behalf of the Circle, I really wanted to thank, everyone attending, of course, our panel today for being so open and honest with us, sharing your own personal journeys and the insights you have. It's, as you said, something that's going to touch all of us and we all need to be aware of, so we really appreciated learning more from all of you. And if everyone can join me in thanking our panel in New Zealand.
We didn't deal with the Climate Change Commission report at all, but you can have a chat to Karen afterwards. If you've got any questions on that.
I just wanted to thank Karen and her team for the warm hospitality today. Thank you, it's lovely to be here. And to Stuart and the team at DXC for your support, as well as Chartered Accountants Australia and New Zealand, Cordia, AUT, Xero, and the New Zealand Superfund. Thank you so much for everyone being here. As I said, it's just a pleasure to be together again, and I know our team in Sydney are watching us from afar, and I just, they can't believe it. So we don't take it lightly. Thank you for your ongoing support. It means the world to us, and we look forward to seeing you all again soon. Enjoy the rest of your afternoon.